Another busy week for markets, and when I originally started to do these, I was hoping most of them would be about 12 to 15 minutes, and I'm sure they will be over the long haul. But it's been a big week with changes, and we'll see how long this continues. But I'm going to kind of take you through, as you see here, just a recap of what happened last week in the U.S. markets and the economy. China was the big news of the week. I'll go through copper, the inflation, and PMI expectations I have is kind of the next surprise. And then it was also an important week for Bitcoin and the crypto market. So I'll finish off with that. But just to get going in here, I just want to kind of go through this quickly because I still read people uh, just negative and thinking a recession's coming. So here's where we are year to date now. The S&P finished the week up 20%. Every single sector is up. Energy is the only one not up double digits. For the month now, we're up. This is going into the last week. The S&P is about to be up for the 10th time in the last 11 months. Again, not something that's typical of going into a recession. AI is not driving this move higher. So the white line is the AI, the Goldman Sachs AI pairs index, which is the winners of AI on the long side, the losers on the short side. And you can see the S&P is going higher. That's because things are broadening out. You had the equal weight S&P make another new high this week. And then globally, this is the MSCI World Benchmark Index ex the US. So we're even getting a breakout. And what you can see here that's interesting is '07 to 21. We're getting a breakout here. This is a bigger story. I think this has a lot to do with AI. I'm going to go through some other things, but I also think China fits into this in terms of the way you should look at global markets relative to what's happened in the past. But MSCI World ex the US is breaking out as well. In terms of the economic data, very quickly, claims, I'm going to just keep showing this because I keep reading that the job picture has weakened, and claims is where you want to look. And the claims, the weekly 4-week average is down again. The continuing claims, like I've said repeatedly, is basically the same level it was last year, still at very low levels. Interest rates are starting to see a benefit. Refis continue to boom. This is the quarterly increase in refi activity. Again, what you've had now is a drop from almost an 8% peak in 30-year mortgage rates. We're down to, I think we closed just above 6% on Friday. We had a conference board come out with consumer confidence. It came out weaker. That got people excited who want to be negative. I just want to highlight going into recessions, going back to the 1980s, generally you've had a multi-year peak before a recession where people get over their skis on the investment side. We are not only nowhere near and have not been at multi-year highs beforehand, but here's what you have. We're at the same level we were effectively in 2014, and we are in the bottom 20%. So sentiment is not high. This is not a market that is positive, and I think people should be, or an economy for that matter. And to highlight that, just remember it was only, this is from early August. It was only in early August that people were coming on TV saying we need an emergency rate hike, we need a 75 basis point move. Cutting rates aggressively into a GDP of 3% over the last year, and with a quarterly expectation in the most recent Atlanta Fed GDP now of 3.1%, it's just, again, there's too many people that are negative. And one of the reasons that people became negative in August, remember, this is from August 21st. These were the benchmark revisions for jobs. So you already had people in their brains very negative on the economy. Most of those people, if you go back and read, they've been negative for multiple months, if not years, looking for a recession and looking for rates to move lower. You had a benchmark revision of 800,000 down. That means that the job creation was less than what was originally expected. That got everyone all excited. And then everyone expected this week, as we got the GDP revisions, that you'd see the same thing. And instead, what happened is the GDP revisions took everything higher, meaning the economy was stronger post the pandemic, and not by a little bit, by a significant amount. One of the places that people, even recently, had debated with me on the economy was on GDI, or gross domestic income. Well, there had been a discrepancy between GDP and GDI, and now GDI has been revised up significantly to get it close to GDP, and that's again where where you have all these changes that are going on. You can see this on here, and what the other place where people had become negative was on the savings rate, and the savings rate had been coming down. Well, that got revised higher to where now it's back to higher than it's been. So as you go through this stuff, there is a risk here, and the risk is what Ed Yardeni, and I've been using his stuff a lot. I've given him a shout out on this because his free charts online are just great to go through. He's had a good call on the market, and I kind of agree with him that by cutting rates, if you don't have a recession, it can trigger a melt up in things because the economy already is strong. And I think that is a risk here, at least when it comes to the market. I don't think the economy is going to accelerate in any big way. But as the market goes higher, remember, the S&P is now up 34% year over year. It's a $55 trillion market cap right now. So you guys can do the math yourself. That's close to, even if you take it backwards, you're talking about 18-ish trillion dollars of wealth creation over the last 12 months. How do you get a recession when the size of the wealth creation solely from the stock market is that large? So it's just very hard to kind of put that together. So now I want to shift into something I did last week, and I highlighted this, and this is the exact same chart I posted in the video last week, which went through from a contrarian basis. What we were looking at here, one clear signal is that China is hated. So if you just read this and you go through, you can see that China was hated, and it ends with something I said last week too, which I'll go through. China's cheap, but no one wants to get involved until there's some real stimulus or sign that Beijing truly cares. And these are all the places. It includes commodities. And what you can see here is it was the most negative that people were on, or the least overweight in commodities, or the most underweight in effectively 8-9 years. I highlighted that home prices had been worsening, and that this, if China's ever going to turn around, the real estate market is what drives everything in the country. Unlike the U.S., about 80% of the wealth is in the real estate market, as opposed to the U.S., where a good portion of it's in the stock market. So what you're left with is the Chinese government eventually had to go. So what I said is I would watch here, and if you get any sign that China is serious and does anything to stimulate, and you get a change in this, it's going to matter. So what happens? China, and I'm just going to go through this really quickly because by the end of this, you're going to read, for every positive piece on China, you're going to read at least 5 that are still negative. And by the end of this, I'll take you through why I just don't know how people can fade in a world of quantitative easing. So it wasn't just the stock market. You've got cuts to rates, you've got RRR cuts, you've got property market support in terms of the mortgage stuff, and you've got the stock side. The key thing in this is an FT article. There's 2 components. Unprecedented. They brought out new tools. First time the P is innovated. And if you go read and you read what they said as they announced this is serious in terms of their attempt. Whether or not they're successful, you can debate that down the road. But they also said the funds allocated could be doubled or tripled. So what I want you to think about is when we did QE1, people doubted that. When they came into the market during the pandemic and printed money, it was doubted the entire year. I remember talking about inflation in May of 2020, and most people thought we were still going into a depression. So people can be wrong in terms of underestimating this, but the most important thing is QE1, when it started in the fourth quarter of 2008, was doubted completely. We made new lows in stocks, but it kept coming. There was QE2, then there was QE3, and I was at a presentation recently with Kevin Warsh, who was one of the architects of QE, basically said that in his estimation, we've done about 350 versions of QE around the globe at this point. It's not just in the US. So it's very dangerous to fade unlimited firepower if they say they're going to do more. In terms of the context of it, I think people were fading also the size of it. It shouldn't be faded. The stimulus was equivalent to 3% of the entire free float. That's for the initial one, not for the we'll double it, we'll triple it if we need to. 3% of the U.S. stock market would be close to $2 trillion. And if that was the announcement, it would be bigger. So I just think that when you're allowing financial institutions to trade in shares for bonds, you're basically giving them the ability to lever up, even to do whatever they need to do. And this is not China's first time. I was in Brazil during the emerging market crisis for Morgan Stanley. I did open an office there for the firm. And in August of 98, right after Russia defaulted, the Hong Kong Monetary Authority, which again at this point was China, they decided to come into the market. And as you can see, the news item here, and I put a red line here because that's where it was, that marked the low when they said they were coming in to buy shares. That was the low in 98. Again, I don't think when you hear equities being purchased, you should be fading it so quickly. In terms of the Shanghai Composite, it was the biggest weekly move since '08. The yuan strengthened. If you're printing money, theoretically you would expect that the currency would decline. The yuan continues its strength. It's now at the highs of the last year. When the currency in markets is going higher, especially in emerging markets, at the same time that the equity markets are going higher, usually not a time that I like to fade it. But the moves have been significant, and so I wouldn't surprise if there was some sort of a pause. And that's where this week will become important, or the next couple weeks for China, and specifically the Hang Seng. Hang Seng itself had the biggest week since I lived in Brazil, all the way back to 98. People don't, I had a lot of questions on this when I got on the phone with people this week. M2 in China is twice as big as the US. So when China does anything globally that has a liquidity side to it, if it unleashes sentiment and it unleashes animal spirits inside the country, it will have implications around the world. That's where I'll start to get into some of the commodities and the ism. But just so you know, it matters a lot. It obviously matters a lot for anything related to liquidity, gold, Bitcoin, things along those lines. So China M2 on the big side. Pattern shift. This is the first time I think I've done this, but whenever I'm looking at markets where I'm trying to find things that offer good risk reward, I'm looking for pattern shifts. These lines here are very simple. This is the highs for each of the years. So in 2018, the high was made in the first quarter of the year. In 2019, it was made in the first half of the year. In 2020, it was made in the first quarter of the year. Same thing in 21. Same thing in 22. 23, it made it almost at the opening. And here's what we did this year. In the first quarter was the low of the year in the Hang Seng, and now we've made highs. This is a pattern shift. This says to me, don't fade this. You're getting a year where the lows for the year were made earlier in the year and the highs were made later in the year. That is a pattern shift going all the way back to 2017. You had David Tepper go on TV and talk about it. It's worth watching the interview just because of his conviction level. It just highlights that if you're reading people saying, well, this can't happen, China's old, China's got demographic issues, China's got this, China's got that, everyone's in the business of trading. This is not investing for the next 20 years. This is not believing that they're going to do anything more for the next whatever. This is a situation where everyone hated China last week, and the Chinese government said, we want the market to go higher. Plain and simple. And so the market's cheap. Asset allocation wise, I mean, this is another place that shows how bad sentiment is. The allocations for global funds is at insanely low levels compared to the last 12 years. The short interest, FXI had its highest short interest ratio going into the move. So you had high short interest. Volume was the highest on ever last week for FXI. EM had already been doing well. So this white line here is the EM ETF, or the EM index total return of the ETF, which is EXMC. It was already at highs because it's ex-China. So with China down here going down, you can see how these were correlated, meaning EM, ex-China, and China were correlated. Then China went down. Any kind of bump higher and you're going to get a move into EM. So EM is another place where you can go look there. And this I just wanted to bring up in terms of China, because this is what you're having, self-serving bias. Anyone that's negative on China as you read things going forward, just go back a year, go back 2 years and see if they've always been negative on China. It doesn't mean they haven't been right, but a self-serving bias, are they talking about things where they are not going to get off of their view and this doesn't change anything? Next thing is, always remember that the stock markets are like a pari-mutuel system at the racetrack. This is a Charlie Munger quote. Because I was trained, or my father taught me how to handicap races, and I do my Derby piece every year. This is where it really gets important, meaning you have to realize that all the negative things that you're reading about in China were already discounted in the price last week. Doesn't mean we can't go to new lows, doesn't mean we can't, that this won't work. But the Chinese government said they want this to work. They've finally gone in and they've done something different that's innovative. I wouldn't fade it at this point. And in the case of Druckenmiller, I think this is important just from a Bayesian perspective. You got new information. He watched the Malay speech back in earlier in the year. I mentioned Malay out of Argentina, along with Bitcoin. I think this is an important shift that's happened globally. I think EM is going to benefit the most from AI and from crypto. I think it gives them the chance to play catch up and not have to build all the money on the infrastructure side. So I just think that reacting quickly to China at this point and at least opening your mind that something different could be going on. Now, the next one here, before I get to it, I just want to make sure when people realize the number one thing I've read as to why you should fade China, it gets brought up in almost every structural problem, which is Japan. So this is Japan. So here's the Nikkei saying that QE can't work or saying that printing money can't work is ridiculous. So this line here, this yellow line, this is the Fed's balance sheet. This is QE1 right here. Japan wasn't working, it was China. Their demographics haven't gotten better. Nothing in Japan has changed dramatically structurally that China couldn't do as well. Everything changed once the printing presses were basically brought out by the Fed. Once these new tools were created, this is how the Nikkei did. So you can sit there and fade China if you want, but I just think it's a mistake to sit there and say that if they want to get their economy going, they absolutely can. They can just hand money out through helicopters, or they can do what they did this week. So I wouldn't fade China. Now let's move on to some other places where this will surprise. I mentioned the ISM. And last week, the focus was on this, which is, okay, the Fed's cutting rates. We've got an ISM that's down at 47. This line here is how long it's been below the 50 line, which is going almost on, I think it'll be 2 years as of October, November. These two here are times that we were at this level and the Fed cut rates without a recession. These are the recession periods. So I already mentioned that I thought that you could get a bounce in the ISM purely from the Fed. It wouldn't be that big. I was on with Raoul Powell this week, and he had a tweet that went out using his global macro investor model on interest rate changes with a 6-month lead. So now with central banks, not just in the US, but around the globe easing, and now China's come through. Japan said they were just kidding with the rate hike. You're really getting a push. So he's got a bounce here on his model for the ISM. My risk grow index, which again is focused on stocks outside the US, commodities, and a weaker dollar, has bounced up significantly. So getting this equates to an ISM very similar to where Raoul's was, somewhere in the low to mid 50s. And what should happen if the ISM does bounce is copper should be there. So I had the high conviction trade of copper. I just want to take you guys through copper and at least at a minimum start thinking it now in the way that it should be. You have oil prices that have not bounced. Anytime people hear commodities and hear the ISM, they start thinking of crude. This is not an ISM bounce that is related in the same way. This ISM bounce is related to things regarding the energy transition and AI. This is not a go build a bunch of building things that have gone on. And that's why copper to me is the oil of this point, because we're talking about electrification. Now, this is the white line here is copper. You can see how well it was doing or hanging in here relative to this orange line. This orange line here is the fixed asset investment year over year for China. It's down at minus 10%. The fact that copper was able to hang up here and break away or diverge from negative growth, meaning no construction in China, even if they get a small bounce up here, I think copper has a big benefit. And part of the reason is now you can go back and read Jeff Curry, formerly from Goldman Sachs. He is the one who said why copper is his highest conviction trade ever. This is from May. And a lot of the reasons get filled into things that have been in the news all year that I don't think people have really paid much attention on. Copper shortages threaten the energy transition. So there's a shortage issue that comes in combined with the demand issue that's needed to do the energy transition to move away from fossil fuels into electric. This is another article that gets into the data centers. Remember, we had a 3 Mile Island news event last week. All of these are long-term stories on that impact copper and its need. There was a news item that came out this week from BHP, came out and just said they're predicting soaring copper demand in the future. You can go read the BHP thing that came out this week. Now, This is something that I just want to make sure, because a lot of people are not only playing for recession, but they feel it's easy to play at least for more rate cuts. You have the Fed there. Although I think the Fed will at least cut one more time, I'm very, very wary coming out of October that people are making a mistake again with inflation. And here's the reason why. This is from the most recent inflation data. The white line here is the core services, and just read this. Core services keeping US elevated. What I want you to look at is this, and this. So when we got up to 8%, core services were actually lower than they are today. What had driven this up there and why it had to be viewed as transitory, at least at the time, this was food, energy, and core goods. So core goods, think of anything related to the housing market, anything like that on the goods side. Well, all of those are now a negative on this, or at least very small. You've got a little bit of food inflation, a little bit of energy from time to time, but you don't have anything on the good side. If we get any kind of change in China, along with the fact that we're getting high refi numbers. Refi numbers typically lead to Home Depot and other places where people start doing housing stuff. If you start getting any kind of shift in the housing market because of rates going down, not just in the US, but globally, you should expect that we're going to see some kind of an increase, at least not a negative. You get back into positives and you can easily see the CPI start to move higher. This white line here is PPI year over year in China. So this led the move down, which makes sense. This is the CPI in the US. So what I just took you through, China led. So if we get any kind of increase in China, you would expect that you're going to start to see a pickup in PPI. So I think inflation is going to surprise. And part of the reason is another component of the inflation stuff staying on the higher side is wages. So here we have the 12-month. So this line here is the Atlanta Fed Core Sticky Index. This is the Atlanta Fed Flexible, or the Transitory Index. So the reason that CPI has come down again is because of the goods side, which is related to China. The problem is this is the Atlanta Fed Median Wage. Median wages have not come down, and I think people have forgotten that as long as the jobs market is still strong, which shows up on every wage category. So I showed this on the last one, but these are the three different wages. You've got the ECI year over year, you've got the hourly earnings year over year, and you have the median Fed wage. So wages are still strong, and as long as wages are strong, core goods services are still strong. We've got the savings rate bump back up. You have the stock market, which is up 34% year over year. We are not out of the inflation situation, particularly if China does what this thing is, which is spark M2. So again, I'm showing this again as we kind of finish up this video by going through the impact to crypto. You're pumping M2. So again, if you're going to get M2 growing in China, which is going to come through a combination of right now stronger yuan and whatever they do on that side to provide liquidity, you're getting strength. This is gold overlaid with global M2. So global M2 for me, what I just went through is Chinese M2, European M2, and US M2 combined. You have about $81 trillion. This chart is overlaid with gold. So you're seeing gold go higher, which is a sign that you should be worried more about liquidity filtering into inflation and filtering into assets. This is another chart from Raoul Pal. This is him doing his own total liquidity index. Leading, that's the white line, and that's Bitcoin. So he's got a move coming in Bitcoin based on his total liquidity. We did have a technical break in Bitcoin last week. We closed above the 200-day moving average, and probably more importantly, we finally turned what had been lower lows and lower highs, and we finally just made a higher low and a higher high. I think the technical picture in Bitcoin combined with the liquidity is fantastic. I think it's going to break higher. I built a proxy for Bitcoin using AI. I went back and did some regressions, and effectively most of this the white line here can be kind of defined as gold for liquidity, copper for the AI electrification and growth in AI, and then QQQs for the innovation investment. Whenever, I mean, people think it has a beta to it. The reality is when you create a regression with the three of them in there, you get something a little bit more close. Well, that just broke out to new highs, so I think that's a good sign. One that is a little surprising, but I guess kind of fits with the copper, the gold, and China is Caterpillar. So this is Caterpillar overlaid with Bitcoin. It also broke out this week, which I think is a good sign. And then finally, I've mentioned that I'm going to start covering this more and more. This came out last month, but I wanted to highlight what had happened with stablecoins in the last 2 weeks. So again, stablecoins hold around 1% of the U.S. Treasuries. When you go through this and you look at the numbers here and you put where Tether by itself is in terms of combined to the money market funds and how many treasuries they own, you're just getting to a point here on treasury bills that you can't ignore what's happening in stablecoins, which again will measure up and combine. Those are the growth vehicle for digital payments. It's also a benefit that's happening in emerging markets. You're getting more usage there. It just shows that the ecosystem of crypto is growing and it's becoming more of the macro market cap. And the reason I wanted to bring it up this week is because the stablecoin market cap took out the previous highs in 22 finally. This is a big deal just because I've watched enough markets. I've been involved in bear markets. I obviously was an EM trader from 94, starting with Mexico into 99. When you take out the prior highs of something that has so many unwinds, it's usually a big sign and you usually break away from it. So I think crypto's in a breakout phase. And that's it for me this week. I hope you guys keep subscribing, sending it around, and I'll keep coming with them. Thanks.